Hi Brandon, how are you doing today? Thank you for meeting with me.
I'm doing well. Thank you for inviting me.
I was visiting with my banker recently. He told me that a lot of cattle producers are using livestock risk protection to protect them from falling cattle prices. Can you help me understand the basics of the program?
I would love to. Let's go inside and I'll tell you everything you need to know. USDA's Livestock Risk Protection, often just called LRP, is a product that has seen a lot of improvements lately, making it much more affordable and user-friendly. The LRP program is designed to protect producers against unexpected cattle price decline. In other words, when the cattle market is expected to be one place and it falls to another, LRP insurance coverage can protect you from that decline for a little bit of a fee, which is called a premium. LRP only covers price decline, not death loss or any other loss. Let me give you a basic example to get started. LRP allows you to create a price floor in the future. Let's say in 9 months the LRP price offered is $250 a hundredweight, with an $8 premium. This contract allows you to put a floor of $242 on the price, 9 months from now.
So, I can lock in a future price, and if I don't get that price when I sell, then LRP will pay me the difference?
That's an excellent question and is often the most misunderstood part of LRP. The LRP program actually looks at the cattle market as a whole, not what you sell your cattle for. The reality is when the cattle market goes up, then what you receive on your ranch likely goes up, and when the cattle market goes down, you're likely to receive less when you sell. The two are correlated, but LRP is based on the cattle market and not on the price you receive.
How are LRP prices determined? And what price is used to settle LRP contracts?
The USDA uses the feeder cattle futures market to set the LRP coverage prices. In the CME feeder cattle index, often called the cash price, to settle contracts when they end.
Will you explain what the feeder cattle futures market and CME feeder cattle index are?
The feeder cattle futures is used to set LRP prices. The futures prices are based on agreements to buy or sell feeder cattle at a predetermined price on a specific future date. The price of feeder cattle futures is influenced by various factors, including supply and demand dynamics, feed prices, like corn, weather conditions, and broader economic indicators. Traders and investors analyze these factors to make educated guesses about future cattle prices. The result is a 12-month forecast of cattle prices that is updated constantly as the traders and investors buy and sell these future contracts. Now let's talk about what price is used to determine if your LRP contract will pay you when it ends. The CME feeder cattle index is used to settle LRP contracts. The index is a 7-day rolling average of the prices for 7 to 900 pound steers that are sold in a 12-state region that is updated daily. These numbers come from local auctions, video and online auctions, and direct trade sales.
Okay, I think I understand more about the feeder futures and cash markets, but how do they work with LRP?
Let's walk through an example from your operation. Can you tell me when you usually market your cattle, what they usually weigh when you sell them, and how many you sell?
Sure, I usually sell around the end of October. They should weigh about 700 pounds, and let's start with 100 steers.
That's great. There are a few terms to understand as we begin. The price that the market expects in October is called the expected ending value. You could also call it just the expected price. This price is what the market estimates cattle will be worth in October. The USDA provides flexibility in your coverage. You can choose the level of coverage that works best for you. The level you pick is called the coverage level. High levels of coverage have higher premiums, and the lower levels have lower premiums. Let's give a more detailed example. We'll say the expected ending price is $250. That means $250 per hundredweight. Let's say you decide on a little lower coverage and choose 96% of the expected ending price. 96% of 250 is $240. This coverage level establishes a coverage price at $240. If the price falls below $240 when your contract ends, you will be owed an LRP insurance payment, which is called an indemnity. The cost to own this coverage is called the premium. Let's say the premium for the 96% coverage level in October is $5 a hundredweight. In order to see what the cost per animal is, we would multiply the premium price by 7, because the premium is calculated in hundredweight. So for $35 per steer, you can establish a coverage price of $240.
Okay, now explain how it will work at the end of the contract. Tell me what happens if the price goes up. And what happens if the price goes down.
In October, on the day your LRP contract ends, we compare the cash price for feeder steers to the LRP coverage price you established 9 months ago. One of the advantages of LRP, as compared to working with futures and options, is there are no unexpected margin calls. If the price stays steady or goes up, you know exactly what the cost of your LRP contract is and it will not increase even if the price goes up. First, let's say the market fell and the cash price for feeders is $210, well below the $250 that was expected. Remember, a 96% coverage was selected, which put in place a $240 price floor. We would subtract the cash price from our floor price to determine our insurance payout or indemnity. In this example, the difference is $240 minus $210. A $30 difference. Since we insured 700-pound steers, we would multiply the $30 difference by 7 to arrive at a $210 indemnity per animal. The premium was $35 per steer. In this example, the $210 indemnity minus the $35 premium results in a $175 net indemnity per animal. In that $175 indemnity multiplied by 100 steers equals a $17,500 payout. Now let's do a scenario where the price goes up. This time, the cash price for feeder steers is $270, well above the expected price. Since the price coverage you chose is $240, your LRP insurance will not pay any indemnity and you will be billed for the total premium, $35 per steer, but you will be able to take advantage of higher market value.
But, what if the ending price is right in the middle?
Great question. Now let's say the feeder cash price is $238 on the day your contract ends. We take your coverage, $240, and subtract the cash price, $238, and we get $2. You are due an indemnity of $2 per hundredweight, so 2 times 7 is $14 per steer. Remember that you owe the $35 per steer in premium. If we reduce your premium by 14 per steer, that is 35 minus 14. The premium owed is $21 per steer for a total of $2,100.
Thank you, that makes sense. Do I need to prove that I own the cattle I insure?
Yes, it is very important that you own the cattle you insure. USDA has provided a tremendous amount of flexibility to try to make sure that LRP works for cattle producers. USDA does not want to have LRP used for speculation purposes. It's meant to protect cattle producers from unexpected price declines for livestock they own. This means that if you're due an indemnity, they are going to require you to provide verification that you own the number and type of livestock that you insured. For example, if you insured 100 head of steers, you're going to have to provide documentation from a disinterested third party that you own 100 head of marketable steers during the insurance period. This documentation will need to include the name of the insured, the number of head insured, and their weights. One of the easiest verification documents is a sales receipt.
So what if I wanted to sell earlier or later than my LRP contract end date? Do I have to sell on October 26th? And, do I have to sell all the livestock I insure?
We try our best to align the ending date of your contract with when you will typically market your cattle. This is so that the market the day you sell is aligned with what you're most likely to receive for your cattle. There is one rule that you should be aware of: you cannot sell the insured livestock more than 60 days in advance of when your contract ends. For example, if the end date on your contract is October 26th, selling prior to the 26th of August voids any indemnity that may be due. However, LRP may allow you to transfer your coverage and the buyer could benefit from the LRP policy. If you decided that you wanted to retain some of your steers, that's just fine. You can retain your livestock and still be eligible for an LRP indemnity. You will still need to provide ownership verification for the livestock you retain. Often a signed letter from your veterinarian or some similar disinterested third party works well.
What happens if some of the cattle I insure die?
The reality is, sometimes unexpected things happen. USDA provides a lot of flexibility. USDA allows producers who have death losses to provide notification to the insurance company within 72 hours of when they become aware of the loss. If this process is followed, you will still receive an LRP payment. Basically, the death loss notification serves as verification of ownership. Some people just choose not to insure every animal that they own, simply because they don't want to have to worry about reporting death losses within 72 hours. Remember, at the end of the contract you must verify ownership of all the animals insured. If your sales receipt only shows 96 head when you have insured 100, you won't get paid for the 4 that are unaccounted for, but will still have to pay the premium for them.
What happens if my steers are heavier or lighter than the 750 pounds?
Generally speaking, USDA is okay if your livestock don't weigh exactly what you thought they would weigh when you established coverage. It is okay if your LRP contract insures 750-pound cattle and they ended up weighing 850. Your LRP policy will still be based on the 750, not the 850. USDA does have a rule around the two different weight categories. The first weight category is up to 600 pounds, and the next category is weights between 600 and 1,000 pounds. One place we need to be careful is when the weights cross that line on the low end. In other words, if you insure something above 600 pounds, in the weight category between 600 pounds and 1,000 pounds, then it is important that they don't weigh less than that lower limit of 600 pounds at the end of the contract. If that happens, USDA is going to deduct some of the indemnity.
I understand that prices are based on the feeder cattle futures, but lower weight cattle are worth more per pound than heavier animals. How does LRP take that into account?
You're right, a lower weight animal will likely bring a higher price per pound, and heifers are usually discounted slightly. LRP makes adjustments to account for these differences. It isn't perfect, but it is simple. First, LRP breaks up feeder cattle into two weight categories. Up to 599 pounds and from 600 to 1,000 pounds. Cattle that are 599 pounds or less are valued at 110% of those in the 600 to 1,000 pound range. This 110% attempts to account for the higher value for these lighter animals. Once again, it isn't perfect, because we all know that an animal that is 650 pounds will receive more per pound than one that weighs 1,000, but the LRP program doesn't worry about that. Second, LRP always values heifers at 10 percentage points less than the value of steers of a similar weight. If a steer is priced at $250 per hundredweight, the same weight heifer will be priced at $225 per hundredweight. LRP values lower weight animals at 10 percentage points more than the value of a higher weight animal. So if a higher weight steer is priced at $250, then a steer in the lower weight category is priced at $275. What is the result? It doesn't matter what weight the animal is or whether it's a steer or a heifer, if the coverage level is the same, the contracts all pay at the same time. Further, the premium will be reduced or increased nearly identically to any adjustments in value. For example, if you insure heifers, the cost is about 10% less than steers, and when the LRP contract pays, it will pay about 10% less.
So basically, I should just insure the animals I have where I expect them to weigh at the end of the insurance contract, and it all works out the same?
Yes, that's right.
You mentioned that I must own the cattle before I can create an LRP contract. Do I have to wait until all my calves are born to do it?
No. If you're a cow-calf producer and you own pregnant cows, then USDA allows you to insure unborn calves. Let's go through a hypothetical situation. Let's say that you are going to calve in April, but it's March, and the price in the fall looks really good to you, and you want to lock in an LRP contract. This is a great time to utilize the unborn category of LRP. The rules of ownership are slightly different. You have to prove that you have an ownership interest in pregnant cows.
Okay, so how close or far out can I create an LRP contract? And, when are premiums due?
LRP provides a contract just about once a month. The earliest contract is 13 weeks out, and then usually about every 4 weeks after that. These contracts are called endorsements. There are 10 LRP endorsement windows: 13, 17, 21, 26, 30, 34, 39, 43, 47 and 52 weeks. The longer contracts are sometimes not offered. The idea is to try to select the week endorsement that is nearest to when you'll be marketing your cattle. It is also important to note that the premium for your LRP contract is not due until after your contract ends.
Can I pick any price that has been offered recently?
The LRP daily offerings are the only option for that day. The daily LRP offerings are usually released around 2:30 p.m. Mountain Time. Once the prices are available for the day, you can decide whether you want to lock in or not. The LRP prices change daily and are only available for that day. LRP is typically offered Monday through Friday, and contracts have to be established sometime between 2:30 p.m. Mountain Time and before 7:25 a.m. the next morning. To be safe, I would suggest that you call me in the afternoon once the prices have been released.
Where could I go to see what LRP endorsements are offered each day?
A great website that shows you every contract that's available is the LRPcalculator.com. It is an easy place to see the daily LRP offerings.
This sounds really good. How do I insure my cattle?
Signing up for LRP is a simple two-step process. First, we need to fill out an application. There is no cost to submit an application, and filling out the application doesn't commit you to ever use LRP. The important part here is that we make sure that the person or entity listed on the application is the same person or entity that actually owns the cattle, and can prove ownership, as we have discussed. Since we often use sales receipts to prove ownership, it is important that the name on the LRP and the name on the sales receipt match. The second step is to establish coverage. This step attaches an endorsement to your policy for a specific time, at a specific coverage price, with its associated premium. Endorsements also need to be signed and submitted. This process is simple. You can just call or text me the number of head you want to insure, the specific end date you want, and the type of cattle you are covering. Once we know that, we can go through the coverage level options and get everything signed electronically over email. I understand that this has been a lot of information. Please keep in mind that LRP rules change and we haven't covered everything about the program today. If you have any questions, feel free to call me at any time and I will be happy to answer them.
Thank you for meeting with me, Brandon. I appreciate your time and will call you when I am ready to lock in my LRP coverage.
You're welcome. Let me know if you have any more questions and have a great day.